Trading futures and options on futures involves substantial risk of loss and is not suitable for all traders and investors. Oftentimes in futures trading, you have a high combination of leverage and volatility. And although this could be an equation for opportunity, it's also an equation for risk. So be careful. Only fund your futures trading account with risk capital. My personal definition of risk capital is money I could afford to lose, doesn't change my lifestyle, or overly stress me out. As human beings, we make bad decisions when we're under stress, so be in a good spot. Remember, micro contracts could be friends. Take it easy on the day trade margins. You get plenty of leverage without maxing out on those day trade margins on a regular basis. We'll be taking a look at a real-time simulated live NinjaTrader trading platform today, and none of this should be construed as trade or investment advice. Past performance not indicative of future results.
Well, good afternoon, good evening, good morning. Welcome to Traders Workshop for Tuesday, December 19th. I'll be your host, Tom Schneider, CMT with NinjaTrader. And as we always do on Traders Workshop, we have someone from our ecosystem, the NinjaTrader Ecosystem, here to help you with becoming a better trader, hopefully. This week is no different. In fact, this will be the last Traders Workshop of the year, and it is my great pleasure to have back on the one and only Larry Williams with us at Traders. William, how you doing, Larry?
Hey, good. Thanks, Tom, very much for having me on. The one and only. Maybe none left anymore, but it's always nice to be with you guys and talk to people about trading, trying to share some of the things I've learned. So I've been looking forward to this.
Well, we are too, and we talked about your appearance this morning. Jim and I do a morning show on Tuesdays, and so hopefully those people coming over from the morning show stick around and watch you and learn from you. But I do want to, before we get into it, I do want to remind everybody that the chat is open and you can ask Larry questions. So if you want to go to the chat, if you're watching on YouTube and you want to join our NinjaTrader chat, you can go to ninjatrader.com/events. That's EVENTS, and hit the play button. When that happens, you'll open up a chat window. You can put in a handle or a name, and then you can drop in a question or a comment for Larry. We encourage you to do that. We have mission control on the spot, ready to push forward those questions that I can ask Larry. So feel free to join the chat. But, looking forward to today, because today, last show of the year, interesting year this year compared to last year, Larry. What do you think?
Oh, they're all interesting years. So, every year is so frustrating. It's interesting. You read the old books, you'll say, well, this was a really hard, it was easier 10 years ago. It was always easier 10 years ago because we saw how it happened. Every year stands on its own legs. And I did really well this year, but I was frustrated at times during the year. That's just the life of a trader. This is it's a business of ups and downs, and your emotions can go back and forth quite a bit in any given year, as it will this coming year. But if you have a little bit of a view of the future, it sure helps a lot to handle the future. We're going to talk about the future and the fear of the future a little bit here in my slides, but there's never an easy year.
Yeah, and Larry, just a little bit of information. Jim and I, for fun last year, we did a little bit of predictions in 4 different asset classes, 4 different markets. And Jim has a different background than I do, and it just shows how hard it is to forecast the market even a year out, which is why I think day trading is so interesting, because you don't have to do that. You can look, it's nice to know, but it's really just kind of a guidepost for what you're trying to do today. You've got a little more immediate information, immediate data coming in. Just to let you know, Jim and I are 2 and 2, right? He's closer on 2 markets than I am. It just, it's kind of sometimes that way when you go that far out.
Well, I think I'm going to show you some things today that helped me understand in advance what was going to happen this year and an idea of what's going to happen in the coming year. I have worked so much with cycles for the last, actually since 1962, but the last 4 or 5 years, my cycle understanding and mathematical approach has gotten a lot better. I think we can get a pretty good idea of a market. We'll talk about that in a moment and what I think is going to happen in this coming year. And if you have that perspective, then you can persevere. You can have the patience to sit through this stuff. But if you don't have a view, you don't have a perspective, then you can't persevere, because you don't know what's going to happen in the future. So to have some type of view, whether what the market is going to do today, I'm going to show some short-term trading tactics here in a minute, or whether it's a very long-term view, you need to have some type of a view or bias so you can really act responsibly as a trader or an investor.
Oh, completely agree with that. And again, want to thank you again for doing this, for coming on the show and helping our traders, Larry. If I didn't say that at the beginning, it certainly is what we here at NinjaTrader are thinking. So again, want to thank you.
Well, let's hope it helps.
Yeah. Let's get into it. Let's see what you have to.
Great, let's do it. I'm going to show a pattern that I've used a long time. It's a short-term trade or an entry idea. I'm going to show this on a daily chart. You can use it on a weekly chart as well, but we're going to talk about daily charts today. We're going to be using it on daily charts. What I'm looking for is a day or a bar when the opening and the close are really close to each other, really significant. That doesn't happen very often, but it is significant. In fact, if we look at the opening slide, look, here's an opening, a day where the opening and close are real close to each other. The next day, whoa, big up day on the marketplace. Another day, small opening to close, and we start to get large ranges. Well, why is that? And how do we take advantage of that? This is what I'm looking for. A day that has a very small open to close relationship. It may look like that. It may look like this. I don't care if the close is higher than the opening, the close below the opening. For this point, I don't care if it's an up close or down close. I'm just trying to find days where I have a really, really tight open to close relationships, because what I've discovered is the market can't just sit in a small open to close relationship. It's so congested, it will break out of that congestion in the next day almost always, or the next day within 2 days. So if this is a setup, so whoa, the market's really, the forces are even here, and boom, one is going to win, or either going to have a big up day or a big down day. So it's a great setup for short-term traders. So that's what I'm looking for to begin with. If the close is less or greater than the opening, as I said, it doesn't matter. If the close is high in the range or low in the range, for right now, that doesn't matter. What I initially want to do is just find that very small closed open relationship. That's all that I'm looking for. You need a very small open to close. And in terms of percentages, we're going to talk about percentage within like 5% of the day's range open to close. But I just look at it in charts, hell, like they're really close. Why this works is because a tight closed open relationships means you've had congestion, and the market cannot stay in congestion. If there's any real truism of the market structure, it's that we go from large ranges to small ranges. We go from small opening to closes to large opening of closes. The opposite side of this is equally true. When we have very large open to close relationships, the market is then going to congest. So what I want as a short-term trader is when the market's going to be expansive, so I have the potential for a good move coming tomorrow or the next day. And the thing that singly points that out is small ranges and or small open to close relationships, because that's congestion, and that usually means we're going to have a pretty good move coming in the marketplace. Here's some examples. We're looking at crude oil this year. I marked off days really small open to close relationships, and the next day, large open to close relationships. Small open to close relationship, whoa, big boom the next day. Small open to close, big rings the next day. You get the picture. These are really important considerations. When people just look at the chart, they don't get this. Very small open relationships of open to close invariably set up an expansive range the next day or week. So when we see this congestion in the marketplace, it's an alert to me that we may have a good trade coming tomorrow. Once we've found congestion, though, the big thing is which way is the price going to move? Like, okay, it's gonna blast off tomorrow, up or down. You have to know that. You have to have some sense of direction. We talked about earlier. You have to have some sense of perception of what's going to happen. So, how do we answer that? In a pretty easy way. Now, here's the same pattern. We have a large range day, close to the low. It has a small open and close relationship. That's what we're looking for. But notice we look at the prior day, it looks like, oh, the market ran way up over here. It's probably going to come down tomorrow. Whereas this market, it ran way up and came down tomorrow. It looks like this type of market could bounce and come back here. So the pattern, one day pattern may look the same, but I want to look at that in perspective of what the market's been doing, because that's the key to this thing. what most traders expect is what happened today was going to happen tomorrow. They're not thinking of a reversal. That's what we're looking for. We can make that a little simpler by saying, if it looks really bullish, in other words, the market looks like it should rally tomorrow on one of these unique days, I'm looking for sell. If it looks really bearish, the market closed in the low end of the range, or it ran way up and maybe it's still up for the day, but it's low in the range below the opening. It looks emotionally bearish. I'm looking for a reversal. I'm looking for a buy. So the whole thing here is to catch the average trader or the public by surprise. Usually, when we see these relationships, it looks like the market will go down tomorrow. It usually does. What I want to try to take advantage of is the reversal, when it catches everybody by surprise. Because when it does that, short-term traders are in a position of pain, and they capitulate and they rapidly toss in their buy orders in the case of a reversal on the short side, and they accentuate the move, or they'll hop aboard the move. So we tend to get larger ranges when we see that reversal phenomena. So I really am playing off an emotional setup of A, a lot of congestion, the market should move, and B, I'm looking for a reversal. It's going to catch everybody by surprise. Because if I can catch them by surprise, they're going to capitulate. They're going to put in a lot of buy orders because they didn't expect the reverse. They'll have stop orders up there as well, and boom, the market has a substantial move. So that's the basic setup, Tom, that I'm looking for.
Larry, real quick, you mentioned finding a candle that where it's open and closed are very close, and then you mentioned range. Do you find that, is there any correlation between having a tight range where that's true, or where there's, maybe I'm looking at it from a different perspective. If there's a wide range and you find that happen, is there different expectations? And maybe this is addressing one part of it.
Well, yeah, the problem with a small range and a small open to close relationship is your buy at the high or sell at the prior low is just too close. You can get whipsawed too easily because you can break out up, break out down, and you don't, if you have a small range, you don't have an expectation of, well, is it really a bullish day? Will a reversal work here today or not? So I prefer the day that's had some range to it that looks like an exhaustion. You're like, oh, everybody got out and they're not expecting a reversal. It's too easy to reverse a small range day. So small range days, I cover different. Maybe we can do that next time I'm on. But I would prefer to see a range that's pretty sizable, not massive, but pretty sizable, because if I have that small open close relationship and the high or the low is a good distance away, traders are not expecting a reversal in the marketplace. And that's what I'm trying to capitalize on here.
Okay, great. Thanks for that. I wanted to clarify. So we're looking for kind of a longer range and looking for participants like myself, Jim, to be caught unaware, caught by surprise with this.
Yeah, I like this. I like to see everybody in pain, caught by surprise. Here's some examples we can look at. Here's a good example in crude oil where we have a small open to close relationship, pretty good size range. Gee, it looks like the market should go down. It ran up, it came down, barely got off the low. That looks like we should continue down. And emotionally, at the end of this day, traders felt pretty negative. I know that. I feel that. But I go, oh, that's what I'm looking for, a reversal. I want to be a buyer in this day. And we have the same type of thing over here, which would be nice if we don't get to the high the next day. So you don't always get that reversal, but often you do get the reversal. Here's an example here. We run up, we should come down, we close below the open, close down for the day, typical reversal day. Oh, we go up. Same thing over here. Look, it's a very small open close relationship. We ran up, we couldn't hold the new highs. We closed off the high of the day, and the next day, the move begins. So I just love to find this very small open to close relationship. Then, point two, what's the public looking for tomorrow? And where's my reversal point? Now, here it is in the S&Ps. It doesn't matter what market you're looking at. Here in the S&Ps, you see some great examples like, oh, the market ran up, came way off its low, small open to close relationship, should not take out that day's low. Whoa, perfect place to sell. They say it's the same thing over here. It's just, once you start to see this in your charts, go, wow, why didn't I see that before? Small open to close relationship looks like we turn the corner here, we close above the opening, close up for the day, and we take out that day's low, that's the reversal point, and we'll go to the downside. So that's what I'm looking for. If you want to get a little closer to where to get in, if you're looking to buy, you could add today's close minus today's low to tomorrow's opening and be a buyer at that price. So that's one way. There are several ways, but if you need a mathematical, mechanical formula, that's one way you could look as a buying place in the market. If we're going to want to look for a sell point, looking to sell, we're going to add today's high minus today's close, and add that to tomorrow's opening, and that's where we're going to go. But I'm looking for that. We have three things going on here. One, small open to close relationship. B, where's the reversal tomorrow? And then I want to see an expansion off the opening tomorrow in the direction of that reversal. I don't have to absolutely wait for yesterday's high to be taken out if I'm looking for a buy. Here, Tom, I can just, if we expand off that opening enough, more than we've seen the expansion the prior day, we're probably going to continue and then hit that reversal point. So I could be a buyer on the initial expansion off the opening and or at yesterday's high if I'm looking for a buy, yesterday's low if I'm looking for a sell. But I really like to add something to the opening. If we're trading more than we did yesterday, open to close relationship, we're probably going to have a breakout in the direction of the reversal.
Right. I like that. And we talk about that on our shows about breakouts and breakdowns. For traders, we do a lot of retracement, but this is very specific to a breakout or a breakdown. You can't protect yourself with a stop until you're in the position, but once you do, you want to make sure you're protecting yourself. But I like that. I like the mathematics around this, right? We always talk about, long wicks on the bottom, long wicks on the top, that range from high to open or close or low to open or close as being pressure, but you're kind of going the opposite way. It's almost contrarian to that idea. Wow, buyers push this market up, right? And you've got that doji looking candle, that open equals close. You think it would continue up, and really what's happening is the opposite. You're looking for that opposite move.
Exactly. And I'm too old to know what candles are. Candles came way after I started looking at charts, and so I'm not a candle guy. But it's all the same thing. Yeah, as you said, you're looking for a day. It looks really bullish. Like, wow, we closed way off the wick, or what do you call those things? The low of the day. That's what I'm going to call it. And if we take that out, that's a shock to everybody. That's what I'm looking for. But you need to set up first, which is congestion. You can define it as we have with small open to closes. Other ways of defining it as well. But it's first the setup. I got congestion. Then I have that, like, what happened? There's a capitulation at a point that nobody thought we would go to today. That's a sweet spot in the market.
And one thing, Larry, just looking at your charts, those instances that the setups you've identified, there's one thing that I kind of see is, the highs and the lows are going in the direction that you're expecting or that you're anticipating that the market isn't, right? They're looking at one thing, but there's something consistent about it, right? If you're looking for a breakdown, like that first example right there, you still have a lower high and a lower low, right? It's
right. You have a downrange day. It looks bullish because you closed above the opening, you closed right above the prior day. It's like, wow, we should start to rally to be done. Whoa. Or the same over here. This looks like such a bullish day. We made a higher high. We're closing up for the day. We're way off the low of the day. So the public sees that was a good bullish buy day. We're way off the low of the day, and that's where my failure point is. I'm just looking, and the problem is these large range days. Remember, that the opposite can take. Large range days usually when you go sideways. Large range days, then you go sideways for a few days. Big range days, then you go sideways. So large range days to me are kind of like loss leader advertising from the grocery store. Everybody rushes in to buy milk because it's 10 cents a gallon. That gets them into the store. And then they buy the other stuff at high prices. The public gets attracted by large range days. Then they get in the store and it's congestion. And you just see that time and time, large range congestion, large range congestion. Large range attract the public because this is going to continue. It might for a day or two, but usually it's just about it. 2 days, they say, oh, large range. No, good, they get in, and then the market goes sideways. And be so careful of loss leader advertising or large range days, because large range days usually beget small range days.
Right.
And small range days beget large range days, which is what, as a short-term trader, I'm looking for is an expansion, the opportunity to make some serious money tomorrow. I need large ranges tomorrow. Well, what predicts large ranges? Contraction, congestion. Well, let's see what else we have to talk about today. Oh, let's close the door in 2023 as we're just about the end of the year. I kind of like this guys trying to claw, and that's kind of how we felt at the first of the year. Like, what's going to happen? What's the monsters in the closet this year? What's monsters in the closet for 2024? This is one of the forecasts I made last year, not my official forecast. We'll look at that in a moment. But all it is, I think that politics, presidential politics matter in the stock market. My good friend E.L. Hirschfeld wrote about this back in the 1960s. If we were to take from 1975 forward, the average of all 30 years in office, that's what's happened in prior years. If we look from 1939 to 1971, in other words, this data ends in 1971, this is from 1975 forward, they're pretty similar. So it doesn't matter if we're looking from 1939 to 1971 or out of sample, if you will, from 1975 forward. We see a nice upspring, we come back into the October low, and away we go. Pretty much what happened. This massive rally that we've been in since November, it's right there. It's in phase with the presidential election year cycle that E.L. Hirsch wrote about, and his son Jeff has done more work with it, and I've done a little more work with it as well. It can be very helpful in understanding the future. That was a perspective for 2023. In other words, this was known in advance of what actually happened. Now, in 2022, I did a very long-term forecast. You can see we should come down, up, and then look at what's happening. Start down. 2023 is down here, the big up move, the down move we saw, and the year ends in 2024 over here. So this was data done in 2022. At actually the end of 2021, we had the forecast for 2022, 2023, 24, and now the data, because the cycle starts to wobble over here, I've updated this to see what's coming next. But you get an idea. It's what's most important to me, and I'll share this cycle, and then I'll show you what I think is significant. This was the forecast we made for 2023. I call my natural cycle. It's very complex, but I'll tell you exactly how I do it. I find all years that look like 2022, whether we're close fit to 2022, then pull out the cycles of those years, put them together and forecast them forward for 2023. And that's the blue line. So the blue line was my forecast of what should happen in 2023. Was it perfect? No. When we thought the low would come here, it actually came over here. The high came here, we thought the high would come here. Pretty good over here. I don't expect that any of these forecasts are going to be perfect. What I want them to do is tell me when the significant buy and sell points are in the market, so I have perspective of what's going to happen. And everybody's looking for perfection in the marketplace. It doesn't exist. It's not there. I haven't found it. Sometimes you get lucky and you think that you're good, but generally, knowing this forecast, well, I've had a lot of emails from people that made so much money because we had the perspective. This was going to happen. Now, what's significant about what I've just shown you, I think, is this means the market's predictable. So many people say you can't time the market, you can't predict the market. There's a huge message here. We predicted it. And I've been doing this for 18 years now with my annual forecast. Have we all been exactly right? No. We've been really close most all the time. And that's all I want. Some perception of what the future is going to be like, so I know when to do my best selling and buying during the year. So let's look a little bit at 2024. I'd like to open the door up a little bit, Tom, to get some perspective on what most likely will happen in 2024. Let's start with those election years. We're in a re-election year coming up. Well, how do they usually trade? This is how they usually trade. We'll go all the way back and look at all the pre-election years. Going back to 1956, on balance, this is how they traded. Will it be exactly like this coming? No, of course not. Will it be close? Yeah, and we can do some other things that will probably make it a little bit better with my other forecasting tools. But what we see is some early year weakness, a buy point around July, June, August, and then a nice strong rally and right after the election. And we talked about this last time, remember, just before the election in November, stocks get really strong and stay strong for a couple of days after the election. Year in, election out. The first couple of days of November are really bullish because people are fed up with politics. We elect whoever we elect, and the world gets back together. And it's really bullish time, as you can see, based on those re-election years, is very bullish, starting late October and the first part of November. So there alone gives me some perspective now, the year in advance of what most likely is going to happen in the marketplace. Very long-term outlet for 2024. Very long-term general cycle. You can see how the cycle is done. 2024 to 2025, the trend should be, I believe, will be to the upside. Now, will it be jagged and ragged along? Absolutely. It's not going to go in a straight line. That doesn't happen. But in terms of, are we in a bull market or is it the end of the world, as George Soros has predicted, and Michael Burry, I think is the other guy's name, and Mike Wilson at Morgan Stanley, and the Rich Dad Poor Dad guy who says the world's going to explode in like 20 days or something. I think they'll be wrong, just dead wrong, that we will have a bullish impact on the market in 2024, which means the strategy is to buy big dips, sell big rallies. Don't get frightened of the future. It isn't going to be as bad as everybody is telling you it's going to be. Let's focus on fundamentals for a little bit. This is really interesting chart. The red line is the Dow Jones Industrial Average. The black line are Fed funds. And everybody's talking now about, the Fed's going to lower the discount rate. They're going to lower the rates if they're really bullish for stock. So everybody's bought stock. They're driving stock crazy right now because they know we're going to lower interest rates, or believe we'll probably lower interest rates this coming year. Here's the reality. This is Fed funds, right? Fed funds went up, higher, higher, higher. And look what stocks did. Higher, higher, higher. They started to lower Fed funds. Look what stocks did. Doing lower. Wow. What does that mean? Another takeaway, Fed funds are essentially flat here, trend, flat here, trend, flat here. The Fed seems to have a policy of shifting rates, then going flat, shifting rates, then going flat. I think there's some bearing on that in the future. Let's take a look. Here we see in 2008 coming up to the peak. Interest rates went higher, higher, higher. Stock went higher, higher, higher. Interest rates went flat. They like to keep the rates flat, and they dropped interest rates, and that was the bear market of 2008 and early 2009. Then rates went flat again. It just makes no sense compared to what most people are talking about. But, the nice thing, Tom, about charts is they're the truth. This is the reality of the world. There's no conjecture here. And it continues. There's 2008. Notice how rates go up and stocks go up. Rates go down, stocks go down. Rates go up, and we've had this big bull market that we've been in. Like, really intriguing. So my suspicion is that the first rate cut that we get is going to cause a real strong short-term rally that I want to sell, because it'll probably fade out. You've seen that so often that good news comes out and markets do an immediate reversal. Based on this, I think that's what we're going to see. When rates get cut and we get rallies, they probably aren't going to hold. And I think that most likely we've already priced in the rate cuts that are coming, because everybody, in quote, thinks it's going to happen. And so they're really bullish now. Why wait? Let's buy now, because rates will come. So when they come, they're not going to be what people are expecting. It's going to be just the opposite.
So Larry, I just want to interject, because you had two different ways of looking at the market, using these rate cuts and stock prices kind of as a guide for where we are now, which is generally at the top of the hill in rate cuts. In both 2007, we saw it in 1999 or 2000, and again in 2019. kind of riding that plateau. We're about to get on that sideways motion with the rate, Fed rate. You're talking about, I think I want to reinforce the fact that when you look at the cycle analysis isn't about amplitude, it's about inflection points. So it's easy to look at a chart and say, wow, this looks like the market's really going to go way up in 2024, 25. But that's not really what you're saying here. That cycles chart,
it's the reversal points, right?
It's the reversal points. And that's why these two charts can sit in the same room, can jibe, can be on the same chart even, because, this is more specific. This is more about, when the rate cuts happen, and, you listen to the Fed speakers, you've got a couple that think the cuts are, or I think one Fed governor said, we're going to have 6 rate cuts in 2024. And another said, we're going to have 0. And then everything in between, right? So, how long that plateau is going to be what essentially you're saying. When they get that first cut, that's when you're saying there might be an opportunity here for a pullback, but it still fits in with the cycle analysis.
Yeah, and here's why I think this works. Notice when rates go up, stocks rally. Rates go up, stocks rally, and it perplexes everybody. What people don't understand, what happens when rates go up? There's more money in circulation. Because as the rates go up, people that are holding notes get a higher rate of return. They have more money here than they had down here. And they're going to spend that money on the economy or stocks or whatever. An increase in rates is an increase in money supply, which is why the big increase in rates, we haven't had to have a massive increase in money supply, because the money supply was increased because the government paid higher rates, more money on interest, which is putting more money into the economy. And that's why when we start to decline, we're pulling money out of the market. People just don't get that. That's really, I think, why the relationship exists. And my view, what I think is going to happen, we're going to see some cuts in rates, and then they're going to go flat, not down here, probably flat over in this area. So we're going to get a little bit, we'll get some fun from the Fed, it'll look nice, but they're still worried about inflation, which we've said a couple of years ago to go down. It's done that. But I think we'll see rates come down and then go flat. I think they're in this let's go flat routine, and we're going to see a flat time after the first maybe 1 or 2 rates, then it'll go flat for quite a while. Okay, let's see what else we have. Things that we need to be looking for as a true seasonal in the market. Notice right around the first of the year, this is the Dow Jones Industrial Average. We start to come down shortly into January of the new year. We have that little dip at Christmas time, rally right strongly after Christmas. So usually that's how the markets play out, year in and year out. I would expect we're going to see something like that this year for a precursor of how the year opens, strength, and then that seasonal weakness probably will kick into the marketplace. That's the same thing is true in the NASDAQ, the E-mini. I did an interesting study today, not shown here, but I looked at the relative strength of the mid-cap, small-cap stocks, large-cap stocks, and the Dow Jones Industrial Average. And the strongest market here has been the Dow Jones Industrial Average. And all the books say that the low-cap and mid-cap stock will outperform the Dow. That used to be true when your father or grandfather traded the Dow. But the Dow now has Apple, has Honeywell, has a lot of high-tech stocks in there. The Dow Jones now has led this market to new highs. Today's Dow Jones is not your father's Dow Jones. It has been a stronger market average. It's gone down less and rallied more than what's supposed to, all the books say, the small cap and the large caps. It's outperformed all of them. Keep that in mind. Apple, true seasonal Apple, see what's going to happen in Apple. It's usually the way Apple trades, I would expect, since this is a huge stock in the market, massive stock, that we need to pay attention to the seasonal trend of Apple. Here's a forecast for Rockwell International. This is right out of my 2024 report. This is what we're able to show. There's going to be a peak about January 8th in Rockwell. It comes down to a low, rallies up to about August 8th, comes down to about October 10th, we should see the market rally. The red line is a longer term perspective of the stock. And you can see I made this a couple of weeks ago. We've already rallied even more. Rockwell is really strong today. So right around here, I have the perspective, we're probably going to see the stock come down. And if I really like the stock, this is what I want to add to my position or buy it, or over here. So it gives me perspective. I'm not just operating out of fear. If people want my forecast report, go to ireallytrade.com. It will come out maybe New Year's Day or sooner. I've been working on it literally night and day. What's going to hold you back in 2024? This is such a big question. It's fear. It's just fear is what keeps us from doing really great things. And my fear, and I think it's probably, if I have it, we'll probably all share it, it's the future. To most people, it's a dark room. We don't know what 2024 is going to be like. It's like, I have no idea. And you read, there's bullish news, there's bearish news, there's so many commentaries, and they're all going to try to scare you. You need to get, however you get it, your sense of the future, and that's going to eliminate the fear. My fear is my ability to perform. Can I really maintain the level I've done this at? So your performance is another fear that you have to work at. But the big one, I think, you're going to look foolish. You're going to look foolish. You put on a trade, you lost money. And so I'm fearful to act because I'm going to look dumb, I'm going to look stupid. And you really have to say, you know, you're going to be wrong. You will be wrong. Don't worry about it. It happens all the time. I like this one. This guy died waiting for a good trade. Like, yeah, okay. We kind of all been there at some point. You know, you're going to have errors. Just learn to live with them. If you let your emotions run your life, you're not going to have much of a life. So don't worry. You're going to look wrong. I'm going to have losing trades this coming year. So will you. It's this life. You know, just don't have big losing trades, then you'll get through it. So I think I want to wrap it up here unless there are questions and say, of course, Merry Christmas to everybody. Thanks,
Sure,
Tom, for having us on. If there are questions, I guess we can handle them now, Mike. Tom.
Yeah, my pleasure. And thank you, Larry, for this. And thanks for finding Jim Cagnita's car. He was looking for that. He didn't know where he put it.
That's his car. I like that. Jim knows that car. Yeah, so do I.
Yeah, exactly. He'll be happy that you found it. We do have a couple questions, though. Mary Ellen Reese asks about a cycle question, and it's kind of specific. There is a persistent 18-year real estate cycle, one that would next peak in early 2024. So coming up, supply and demand don't make it look like much of a bear market is probable. Do you have an opinion on the real estate housing market in 2020?
Well, first, hello to Mary Ellen. We've been friends for a long, long time, so it's great that you're here today. And I have to let you down. I haven't studied that. I don't know. I'm aware of the cycle, but what I want to do is look at that cycle versus the real estate ETFs or the real estate funds and see. I haven't done that, so I don't have an answer. Some of these traditional cycles, the 18-year cycle, when I really rip them apart and apply data to them, they don't hold up. So I guess maybe I should add that to my 2024 forecast report. I did look at some of the Fed data on real estate, and I think we're going to see some topping in housing prices this coming year. Nothing drastic, but I think we're going to see some pullback in housing prices. The real problem, of course, has been commercial real estate because of the pandemic and everybody works from home and everybody buys stuff online anymore. But in terms of housing, I think it's going to be soft, but not a disaster. Hope that helps, Mary Ellen.
Thanks for that, Larry. And yeah, I think I have opinions. My wife's in real estate, commercial real estate. And I think the problem with housing, not the problem, but the feature maybe, is it's such a regional issue. And depending on where you are in the United States, you might have a boom or a bust cycle. So, you know, that data kind of is normalized in a way that might not reflect what you might see around where you live. But thanks for that question, Mary Ellen, for that. And thanks for watching our show. Lawrence has a question, Larry, regarding interest rates. So if interest rates in the next 6 years were to end up going to double digits, do you feel that will carry the stock market higher with such extreme rate increases in coming years?
Initially, I believe that it would, because it would be an increase in money supply. But at some point, if it did go to double digits, it's so punitive to people trying to buy money to expand their businesses, then it becomes negative. So there's that balancing point in there. Now, I don't think we're going to see double-digit interest rates in the future. So I'm not worried about that. But theoretically, I hope that answers your question, Lawrence.
Great. Well, Larry, thanks so much for coming and joining us again. And we really appreciate you coming on, and hope you and Louise and your family also have a great Christmas season, and safe travels if you're traveling.
Well, thank you, and everybody that's out there. Yeah, safe travels if you're traveling, and travel early. I guess it's going to be a busy travel year. But just again, thank everybody at Ninja. It's been a great year and a relationship with us, and we have a lot of people that are Ninja traders now, and we hope to see that continue. So thanks very much for having it. It's an honor to be with you guys. So thank you very much, and for everybody out there, good luck and good trading.
Thanks, Larry. And if you want to follow up with Larry, he's at ireallytrade.com, and he's on the NinjaTrader Ecosystem. I want to thank all the viewers for coming, and not to just this show, but for the entire year. We appreciate you. We do this for you. It gets us up in the morning and keeps us going to bed, thinking about the next day, in the evening. So we really appreciate it. I want to wish everybody have a great trading day. We'll see you in the new year. Take care.